Hello, welcome to a video about how to legally make tons of money from coronavirus. You probably heard of that guy that was hoarding more than 18,000 cases or of hand sanitizer. So not that way. This is a better way how you can make money from coronavirus. In something like coronavirus or COVID-19 is also called Black Swan event. So let's look at, and feel free to share this video with your friends and family and watch it multiple times because the concepts explained in this are really, really simple. But feel free to watch it again and again. And also, if there is anything that you don't understand, feel free to Google it. Okay. I mean, in this day and age, there is no excuse for not understanding something. So if I say something and you don't understand that, just Google it or YouTube it. There's a video about that, right? So let me tell you, disclaimer. So I'm not a financial advisor. This information I'm providing you is for educational purposes only. And use this information at your own risk, okay? So what do we mean by Black Swan event? I mean, these are like the textbook definition, which is it's something that is rare, unpredictable, has a severe impact. Although in hindsight, you could say that it was fairly obvious. Why didn't we prepare for it? Okay. So coronavirus is kind of like that, where it is actually causing a huge downturn in the market. So as far as coronavirus is concerned, make sure you take all the necessary precautions and follow the rules and procedures. If you're not supposed to go to work when you're sick, just do that. Wash your hands plenty of time. So I don't need to tell you all of that. But, this is an awesome opportunity that you could use to make tons of money. And something like this, as I'll show you, is kind of rare. And you probably get this kind of opportunity, once in probably a decade or so. So why not take advantage of this and figure out ways to legally make money by investing money in stock market, basically. So in stock market is basically fear and greed, and I'll show you that. So this is kind of like example of fear, which is during a crisis mode, what happens? Like SARS. So stock market went down almost 13%. Same thing with Zika, 13%. And now, actually, when I took a screenshot of this, I can find it later. This was almost a month ago, February 24th. That's when CNBC was talking about this. And between February 24th and now, things have changed a lot. So I just manually modified it. So this is what happens. During crisis, people get scared and they just start throwing in the towel, meaning just selling anything and everything they can. Okay? What happens after crisis? After the crisis, if you see after swine flu, a month after that, like market went up more than 10%. 6 months after, it went up more than 40%. And if you look at it, every crisis was an opportunity that if you would have taken advantage of it, you could have made good money. But there are some over here like HIV and AIDS where it looks like you wouldn't have made money but we're just looking at this 1 month, 6 month time period. But if you look at the longer time period, you definitely made money on all of these. Corona, we don't know, but if you look at these, it says the result is negative, but we are looking at only 1 month or 6 month time period. Okay? But if you go beyond that, you definitely made money. So let me show you, like market actually goes through cycles. It goes up and down. And if you look at S&P, I typically prefer to use S&P 500 because that's a better measure than Dow. Dow is only 30 stocks versus S&P is more than 500 stocks. Okay. So if you look at S&P 500 and you look at the peak, so around 2000, that's where the peak was over here. And you're actually looking at number one is S&P 500, number two, NASDAQ, Dow Jones, Russell. So these are the ones I'm showing you, the four indices, how they behave throughout the years. As you can see, it doesn't happen all of a sudden. Market peak, it took months and months for the market to peak over here. Same thing for the bottom, it took months and months, 4 or 5 months. Okay. Same thing if you look at the '07, top was over here, months and months for the market to peak. Similarly, months and months for it to bottom. Okay. Now, right now, we are over here, and you could argue that it may be different this time. Who knows? Okay. So as you can see, NASDAQ did the best over here. So this is NASDAQ over here, was the top. And kind of like if you see Dow Jones and S&P were very similar in performance. And Russell was sort of in the middle over here. Okay. So this is typically what happens in market cycles, like stocks or the indices go up, stay up and keep going up, and then like this or like this stage, and then they go down. Okay, right here. Okay, so some could argue that we are due for a correction. Who knows? Now, so what I'm trying to show you over here is this is a lazy man's way of making money in the stock market. You could either pick the stocks, individual stocks, okay, or you could just pick index. And what I'm showing you is leverage index. Pay careful attention to this. You are not picking any particular stock. And this is a lazy man's approach. You could pick up some stocks and you could make tons of money, but you never know which those stocks would be. Like, let me show you, for example, over here, let me make this bigger. So these are the top performers in 2019. I'd never heard of these names. Axum Therapeutics, Constellation Pharma, Stage Stores. These kind of look like even made up names, but these stocks did really well. So that's what I'm saying. Individual stocks, you could make tons of money, but you don't even know which ones are those. Or if you're willing to put in a lot of efforts. But this strategy that I'm showing you right now is to make tons of money using a lazy man's approach, just one or two indices. Or leverage funds associated with that. Okay, so let's go back over here. This is, I'm comparing, by the way, individual stocks are Facebook, Apple, so these are like 2, 3, 4, these are all labeled over here. And TQQ is 3 times NASDAQ. That's what I mean by leverage, meaning ETFs are exchange traded funds which typically mimic the index. So just QQQ without the T, QQQ is actually the NASDAQ. So it's the ETF, exchange traded fund for NASDAQ, which means it replicates NASDAQ. TQQQ is 3 times NASDAQ. So if NASDAQ goes up 1%, TQQ will go up 3%. And it's vice versa too. So NASDAQ goes down 1%, TQQ is going to go down 3%. Okay, so 1-to-3 ratio. So if somebody was picking these, really awesome stocks, which is Apple, Facebook, and all, Google, Amazon, Tesla, Netflix. So I'm comparing that. So if you would have, like, for example, number 6 is Netflix. If you would have invested, by the way, TQQ started sometime in 2010, I believe March or May of 2010. So that's why the chart is from 2010 over here. So I wanted to give you from March 2009 to sort of March or February 2020. But since the TQQ started in 2010, that's when I'm using this. So like the best performer is Netflix. You would have made close to 4,000% on that. By the way, when I say 4,000%, meaning your money would have gone up 40 times. See, 100% is your money going up 1 time. 200% is money going up 2 times. So the best stock is Netflix, and your money is going up 40 times. Versus if you would have put money in TQQ, which is 3 times NASDAQ, you would have made more than 6,000%, which is 60 times your money. Okay. So watch this slide or pause this to understand what I'm showing you over here. So you're just picking one. And if you want to diversify, that's why I have given you Russell, which is small cap companies, SPXL, which is 3 times S&P 500, URTY is 3 times Russell, UDOW is 3 times Dow. So these are like, this is number 9 over here is URTY, number 10 is SPXL over here, number 11 is UDOW. Okay. So these indices, 3 times the leverage indices, actually did better than most of the stock, most better than Apple, better than Facebook, better than, except Netflix and Tesla, they did better than all of them. Okay. So individual stocks versus leverage stocks, this chart, and this is from March, actually 2010 till February to 2020, and you can see that you would have still made money. So this is the lazy man's way of making money in the stock market by investing in exchange traded funds, leverage exchange traded funds. By the way, I'm not talking about the simple one. This is leverage 3 times NASDAQ or 3 times S&P. Okay. So why, you must be wondering, why am I saying TQQ? So basically, technology is the future. As you can see, artificial intelligence, drones, blockchain, so on and so forth. Guess what? NASDAQ is 50%, almost 50%. I think it's 48 something percent technology. And TQQ is what? 3 times NASDAQ. Okay. And as I showed you before, between the years 2010 to 2020, your returns were more than 6,000%, which is if somebody had invested $100,000, you would have made more than $6 million. So 60x. Okay. Now, so you are wondering, okay, now we have decided that you want this, the TQQ. So how do you invest, or how do you enter the market? So do you put money lump sum, or do you dollar cost average, meaning, don't put all the money at one time, keep on putting low, but okay. So one could argue that the downturn has just started, and so we should go for dollar cost averaging, which is putting money low by low. And also, we don't know where the market bottom is. Market may drop even more, and usually, as I showed you in the previous slides, market takes a few months to bottom. Okay, and some could even argue that we are at the beginning stages of coronavirus. But here is an important thing. VIX today on March 16, 2020, actually I'm making it after midnight, so it's 17, but still, VIX spiked to 76.25 and it surpassed the previous high. So you could argue, and VIX is, by the way, index or measure of fear in the market. And if there's anything you don't understand, just Google it, okay? Keep it simple. So one could argue, I'm suggesting that you use combination of lump sum as well as dollar cost averaging. What do I mean by that? So by the way, this is the chart of VIX fear index. This was 2008. Guess what? This is 2020. So we are higher than that. So fear in the market is higher than what it was back in 2008. And fear is actually a better indicator of the bottom of the market, as some could argue. So you should buy now. So I'm just showing you a brief calculation for dollar cost averaging. So this is TQQ, the highest the TQQ was 118.8. And so, it kept dropping. So I'm just showing you what the price looks like after, let's say, 10% drop, what the price would be. Right now, the price is around 39 something, okay? 39.50 or something like that. Okay? So it has already dropped more than 50%. Actually, it has dropped more than 60%. So it's somewhere over here, close to 70%, 65% drop over here. So not sure why it's going. So you could, what I'm saying is at each level, buy 10,000 shares. Okay. So if you divide 10,000 by 3564, this is how many shares you would be buying. So at each level, you are actually buying 10,000 shares. Okay. So let's just say for whatever reason the TQQ went down this much. By dollar cost averaging, you have bought, essentially your average cost has come down this much. This is simple math. Basically, what we are doing is at each level you're buying worth 10K. So investing 10K at each level over here. Not sure what's happening with this laptop. So that's why you see the number of shares go up as the price goes down. And this is the cumulative, how many shares you have right here. This is the cumulative amount, okay? So this is how you would be doing it. And if you wanted to do dollar cost averaging, you would be dumping, or lump sum, sorry, this is dollar cost averaging. Lump sum would be just putting all the money at one time. It's up to you. Some may argue that, this is as low as it would get, and you may want to put all the money now or just wait and put a little bit at a time. But in either case, put some money now. Even though market goes down, you're still fine because you can still keep on buying more using this formula that I've given you, okay? Now, when do you exit? This is how you get into the market. So how do you exit? So this is my favorite way to do it, is take half off after your initial investment doubles. So let's just say that you had invested 10K and it has gone to 20K. So what? Sell half. So you have pulled out your initial investment, and the rest of the money is house money, meaning you're playing with that money, and let it ride. Let it just, multiply. Okay, that would be one way. Or leave all the money that is there and let it just ride. And again, by the way, it depends, when you want to use the money. So if you don't need the money now, you want to use the money later on, 10, 20, 30 years, then this money would appreciate really, really good. Okay. By the way, thank you for watching this video. Stay healthy, stay safe, make tons of money. And again, disclaimer, this is for educational purposes only. Use this information at your own risk, do your own research. Anything that you don't understand, watch this video again and again. The concepts are fairly simple. And if something you don't understand, feel free to Google it. All right. Thank you for watching, and make tons of money and stay safe. All right.